Welcome, friends, to the latest October episode of Fund Manager Review at Emkay Investment Managers Limited. I'm your host, Rahul Sejwal, and I'm very excited to get into this deep dive conversation with our CIO and fund manager, Mr. Manish Sonthalia. Just to introduce Manish again, so Manish is our CIO at Emkay Investment Managers, brings in an experience of about 30 odd years into capital markets, across research into Indian markets as well. He's a commerce graduate. He holds a cost accountant degree. He's a chartered accountant. He's a company secretary, and also done his MBA in finance from IISWBM. His research paper, in fact, is a rising consumer class, which was published by the World Economic Forum in 2010. And his market views are something which is often featured in leading Indian and global media. Welcome, Manish sir. How are you?
Okay, all good. Thank you.
Thank you. So I think I'll just get straight into the questions. So global central banks seem to be diverging in their policy paths, right? While the US Fed stays cautious, Asian central banks appear more growth focused. How do you see this policy divergence impacting capital inflows into emerging markets like India?
So yeah, you are right that monetary policies in developed markets as well as in emerging markets are somewhat diverging. There's no, linkage, so to speak, as was seen previously during the global financial crisis. There was nothing called decoupling.
Right.
Now everything was coupled, and India was a part of the global village. But now what we are seeing is that each country is for himself. That deliberalization is the norm. Liberalization was the norm previously. Now it is deliberalization. Multilateralism is dead. Bilateralism is what is in vogue, and because of that, we don't have a problem of inflation. Whereas the developed parts of the world, primarily US, would have a problem of inflation.
Fair.
And that is why we are looking at CPI at around 1.5%. There's further rate cuts that's possible. There are two doubts about rate cuts happening in the US currently. So all in all, I would say that because of this, we don't have a real problem of inflation, at least till the close of this calendar year. We should be looking at rate cuts. And because the US dollar would have a depreciating tendency, there would be a propensity of dollar there will be a propensity of money flow moving out of the US, or let's say de-dollarization is the norm, and in that backdrop you would have basically emerging market stand to gain, and India is a part of that emerging market. Of course, right now what is happening is that India is not getting the flow. The affairs are still steady. So what is actually happening is that this sort of money is moving to Taiwan because AI-led boom which is fueling the growth everywhere.
Sure.
And because India is not so much into AI currently, Taiwan is very much into AI currently. And from all that perspective, the flows, which was in a way lined up for India, is in a way going up to the Taiwanese economy. So, but it's a matter of time. I would believe that growth rate in the country are pretty good, and we should see flows coming sooner than later. There is value. And from that perspective, I think decoupling of monetary policies as well as the depreciation of the US dollar bodes well for India in the medium.
Okay, well noted. So second question comes in that India's GDP growth continues to outpace, I would say, most of the major economies, right? And you also obviously touched on that part. If markets have possibly priced in as much of optimism, from the valuation standpoint, do you see pockets of over exuberance or the earnings growth fundamentals are possibly still supportive on this?
So I think as time progresses, previously we were building in a 10% earnings growth for FY26 and 27.
Right.
After a slew of measures taken by the central bank, that is RBI, and the government in terms of GST cuts, there would be a tendency for the earnings growth for 26 and 27 to move higher than what was previously anticipated. So right now we are working with CAGR of around 12-13% vis-a-vis 10% earlier. So earnings growth trajectory is likely to move ahead, higher than what was previously anticipated. 1 year returns in India have been zero. and or negative, slightly negative. From that point of view, we are underperforming emerging market by a big margin. Emerging market has moved up 25%. We are broadly there. Just about flat. So is there something very wrong with India? I do believe that in the backdrop of the fact that you have earnings moving higher, currency basically stable at around these levels, around 88, 89, and policy cuts in terms of rates still around the corner. There is ample valuation comfort as far as India is concerned. Benchmark Nifty 50, excluding Zomato, which is having very high P multiples in Nifty 50. Market multiples are today trading at around 17, 18 times. That, to my mind, offers ample margin of safety and comfort for people who are actually looking to buy India for the next 2 to 3 years. So I would say that the things are improving at the margin as far as macros of India are concerned.
Oh, so by valuation perspective, you're very much comfortable even in this point.
Absolutely, no problem.
Perfect. My next question goes at given India's strong domestic consumption and the manufacturing push that we have in terms of make in India, how sustainable do you think the current growth trajectory is amid in terms of the global headwinds that we have?
So consumption is definitely the driver of growth in India going forward. COVID till now or till 2024, the investments were driving the growth in India. Now the lever has shifted from investments to consumption as time progresses, because of income tax cuts, because of social welfare measures for women, because of GST cuts, because of 8-pay commission recommendation. There is going to be money available in the hands of the poor. Plus rate cuts around the corner, which is incentivizing people to borrow and spend. And what you're seeing in the banks is also that retail lending is pretty good. It's not slackening in whatever manner.
Okay.
Make in India, government wants to improve manufacturing share in GDP from 17% in 2025 to around 25% by 2030. Atmanirbhar, Make in India. Some of the sectors in the manufacturing push, which are quite important in India's context, is basically automobiles. Automobiles is now more than 21 lakh crores of GDP. Textiles, electrical equipments, pharmaceuticals, electronics. These are some of the areas which is going to drive growth. And government is doing its bit in terms of PLI and electronic manufacturing, particularly per se, semiconductor manufacturing. Automobiles, in any case, 33 units per 1,000 population, we are very underpenetrated.
Correct.
Of course, at this given point in time, there's somewhat of a headwind in terms of manufacturing in India for the world because of US tariffs. That's somewhat of a headwind, but our domestic demand is pretty good. Similar headwind is available in the case of textile sector, which is also a very big component of a in-house manufacturing. These things need to be sorted out. Either we see the tariffs getting lowered in the case of US, or we have to find markets elsewhere, right, apart from the domestic markets per se. So manufacturing theme stays intact. There are a lot of ups and downs. Some of the favored sectors like pharmaceuticals, electronics stay the course. Automobiles export is somewhat of a headwind. Textiles export is somewhat of a headwind. These needs to find course correction in due course, either find different markets or shift the manufacturing and consumption in-house. And consumption, I think, is the new driver of growth in India. Discretionary consumption, particularly both the middle class and in rural and urban areas, will be driving the growth according to.
Perfect. So I guess we're moving from to consumption related. Perfect. Thanks. So in your last interview at NDTV Profit, you noted that the Indian currency is entering and I would say undervalued territory, and much of the tariff-driven downside may already be priced in. Now, against that backdrop, which indicators or triggers being the possibly currency level, export, sector stress, corporate earnings, would you possibly see as the first signs that the market are ready to maybe re-accelerate or maybe, conversely correct?
Yeah, so if you look at the export numbers per se, whatever is getting impacted because of the US tariffs of 50%, We exported close to 87, $88 billion in fiscal 25 to the US, which is roughly around 2% of our GDP. Assuming that 1% of GDP will be taken out because we'll be able to export only half of what we were exporting to GDP. Correct. Is the currency depreciation from 82, 83 levels to 89 or 89 levels? Is it reflective of the amount of damage that has happened because of the export downturn you are going to see to the US? Don't think so. It's more sentiment driven than actually backed by numbers. So from that point of view, I think that the Indian currency is undervalued. And if there was some relaxation, and our commerce minister is on record to say that we'll have a deal soon, trade deal soon, every now and then. So giving the benefit of doubt that there is going to be a trade deal with the US by the fall of this calendar year, and it's not too long away that this fall is going to come. And you know that is going to be a sentimentally big positive. As far as the direction of the earnings is concerned, at the margin, things are only going better. Like 10% earnings growth is giving way to 12% earnings growth. Valuation, because of the progress of time, has only been more conducive. From 21, 22 times, we are around 17, 18 times. So is the valuation comfort also there? I would believe so. Is the valuation comfort also there because of the rate cuts? Rate cuts will mean that there's going to be increase in valuation because interest rates are inverse of the valuation metric. So from that point of view, I think even the valuation comfort is there. I would believe that closer to 24 and a half, 25,000 is closer to the rock bottom levels on the Nifty from the next 6 to 9 months per point of view. And you should build in a 15, 17% sort of an appreciation in market going from here. So we may be traversing towards the lower end of the market range, given that most of the factors affecting valuations are turning the corner, and India is in a sweet spot because we are a domestic facing economy, and the narratives around the US tariffs is overblown. The narratives and the sentimental driven directions of the rupee are also overblown. That is only going to revert to the mean, and that should help things at the margin in terms of the market recovery.
Perfect. Thanks. I think we've also spoken about structural themes, during driving Indian markets. Uh, which sectors, in your view, are possibly the best positioned in India to take kind of next phase of wealth creation? Now, are there any emerging sunrise sectors that you are possibly closely watching as well?
So consumption is an evergreen sector which is turning the corner, as I have alluded to in the past. That is one space. Capital market as a theme is likely to be a big beneficiary. Savings, the corporate loan sector, the banking sector, particularly the PSU banks, because they are very cheap compared to the valuation of private sector banks. And because the RBI impetus this monetary policy is more towards corporate loans, things have only been eased as far as disbursing and granting and commissioning of loans of corporates are concerned. The public sector banks should benefit because of the GST cuts in insurance, both life and health. Penetration of insurance is going to move. Capital market is an evergreen theme in terms of financialization of saving for the next 3-4 years. Hospitals and hotels, evergreen theme between now and 2030. IT is undervalued. All the major negatives in the IT space are broadly priced in. And even pharmaceuticals, generic exports have been spared. And CDMO, the Biosecure Act has come. These are some of the spaces where I think India has a right to win. You have to pick your individual stocks, but I think thematically these are some of the sectors which are in a phase.
Awesome. Also, in your June interview, I think with CNBC, you said that markets would have a range bound kind of 25,000 on Nifty, and possibly look at Qs in H2. So, do you have some kind of direction now? Better?
Yeah, so I think we are broadly at 25,000 between June and September. I think we'll break out of this range. 25,000 will see the floor now. And for the 6-9 months, next 12 months, you should be closer to appreciation of 15% from here. So 15% of 25,000 is basically what we are looking at, around 29,000 levels on the Nifty in the next 12 months. That is what I think is likely part of the course. And, the time correction has gone through. We have underperformed the emerging market. Things are not as bad as is being made out to be. and that is what it creates an opportunity. Only risk in the market is the plethora of IPOs that is coming in. Even though we have an SIP flows of mutual funds to the extent of 25-30,000 crores, but the 2 lakh crores of pipeline of IPOs, QIP, promoter selling, private equity, this is somewhat of a hit. Okay. If you have some TAM on the over bunching up of IPOs, we should be fine. Otherwise, there will be a creation of liquidity suction in the markets, which could act as a headwind for the secondary markets. Valuations are conducive, but it might get cheaper because there is only that much amount of money available in the system to take stocks in the listed space from point X to point Y. This amount of fire ammunition of liquidity is being consumed by the IQs
Primary.
or the private primary market. That's the major headwind. Otherwise, things are fine.
Now coming to our favorite part, on the Indian golden naked portfolio that you manage. Since there was some rebalancing done in May where the small caps or possibly positioning wise came a little down, there was a bit of increase in the large cap space. Do you have struck a right balance in terms of mid, small, and large on this particular portfolio? Any new changes in this?
Yeah, so basically it will be one third a large cap, one third mid cap, and one third small cap. We had diverted somewhat to the large cap space, but I think currently again, it's more or less evenly balanced, one third each into each of these spaces. Between June and September, there have been not been too many changes. We are looking at a few names. Of course, valuations is a important criteria for us to pick these names, but it will be more focused on the consumption, hospitals, hotels, capital markets, IT, and pharma. These are some of the spaces we'll be looking at. Once we have chosen into any of these names, you come to know that in the portfolio. And if there is any valuation miss, if there's any earnings miss, we will be happy to move those stocks out of the portfolio. So it's an active rebalancing that happens. We are looking at the current earnings season. The current earnings season has started. And based on how the earnings shape up for the portfolio, we'll take a requisite call on the books.
So obviously a much balanced portfolio as we go ahead in the market. With that, I think within the portfolio itself, there seems to be a bit of more weightage towards healthcare. Anything that led to you increasing that weightage?
So I think CDMO is one space where we are quite overweight. We think that, the Biosecure Act is only going to help at the margin in the case of India CDMO because, India's proportion of the total CDMO market globally is minuscule.
Right.
And if only, let's say, 2, 3, 4% shift is happening from China to India, our company will exhibit superior growth. And these are very high entry barrier business. You can't replicate some of these business models in the short term. And so I think the moats are big, the growth is going to be good, and valuations are comfortable within 3 price earnings growth. So that is the main reason. It's basically bottom up stock picking that we have chosen this space.
Right.
No other major reason. And we are looking at other areas in healthcare like hospitals also, where we can balance and justify earnings growth with valuations. Once we're able to have a tab on that, we'll have a few hospitals also. But at this given point in time, only its stance is on the CDMO space we have in currently in this.
And given the evolving risky, I would say, landscape, from the geopolitical shift, I would say, to the AI-led disruptions, I think you touched base on the initial phase on this conversation. How should investors think about an asset allocation maybe for the next decade kind of?
Look, the AI related theme is the talk of the town global. Of course, a lot of excesses are also getting created on the AI. There's a lot of capital expenditure that is happening in all the value chains of the AI ecosystem, whether it is data center, whether it is creation of capacities, creation of infrastructure, so on and so forth. Of course, the use cases in AI are only minuscule at this given point in time. The amount of turnover required to justify the capital investments is not yet proven. Now, whether this is a fad or it will justify itself in terms of use cases. Only time will tell. So at this given point in time, we are focused more on the creation of capacity side of the AI. Whether it is battery energy storage systems or whether it is data centers, so on and so on. But in terms of, let's say, the use cases, it's still evolution. It's still evolving. Nothing is cast in stone. The IT companies in India only have a fraction of the revenue come from AI-related businesses as opposed to the traditional IT services business. So I would say that only in future will we know how much of an AI is going to be used. Currently there are not too many used cases. And even in projects which are using AI, the success rate is only 15%. So quite a bit of narrative, quite a bit of capex that is happening in AI related ecosystem. But the payback period or the justification of the monies that are being spent in the AI ecosystem is yet to be proven. So I think I'll be, dealing this space with quite a degree of caution, pick and choose very, very carefully, because you would tend to make mistakes. And I would err on the side of caution when dealing with this thing. Of course, the big picture appears quite good, but when it comes down to picking stocks, currently, the growth versus valuation still needs to be taken a hard look at individual.
Oh, perfect. So you've always, I would say, emphasized on research-driven and I would say process-driven oriented approach. How has your investment philosophy evolved over, let's say, last 3 decades? Because especially we had events like 2008 crisis, we had COVID-19, maybe even the current rate of cycle. What kind of evolution has happened in terms of the way you had the research part?
No, so I have always been a growth investor. No other style of investing, according to me, works the best in India, and I am focusing only on India. So, I would believe that, I have not changed one bit when it comes to picking stocks the way that I have always done, which is basically no compromise on the quality of management. Buy companies which can double their profits in 3 to 4 years. Buy structural businesses in the context of India. Buy those companies which have a good terminal value ahead of free, and buy with decent prices. And here the valuation comfort is 3 price earnings growth.
Right.
This has evolved over a period of time. It's that, 3 price earnings growth is now followed very, very strictly. There is no shortage of ideas in India. So even if companies have fabulous growth, but valuation matrices crosses 3 price earnings growth, I'll be happy taking money off the table. And the waiting game for the earnings to come in company. Previously, I used to wait for 2-3 years. Now I think 1.5 years if the numbers don't come, and I'll be happy to assume that I have been wrong and the markets have been right. So move ahead again, sell those stocks and buy something else which weeks. Not to wait for 2 years, 3 years, because at the end of the day, these are all public monies, and we have to do well for our clients.
Absolutely. I think very well said here by Manish. Very bright insights. And I would say thank you, Manish, for always being with us and be open about it. Thank you, friends, for watching Fund Manager View. Tune in to our show for investment ideas, thoughts, and insights. Until next time. If you like the video, please click like. If you have questions, please comment, and don't forget to share with friends, family, and peers to help them learn more about markets, investing, and growth with MK Investment Managers. I would say until then, happy investing.
Thank you. Thanks, Julian.
Thank you.